Hello everybody, my name is Mike Florin and I'm the owner of Low Cost Mortgage. Anyways, today's your weekly update for April 5th, but we're going to do it a little bit different. I've seen a lot of differences between our interest rates and other interest rates from other lenders, and I want to go into more detail as to why and how we are so much cheaper than everybody else. Now, it's not everybody else in the country, but it's about 98–99% of everybody that we work against or compete against, we're beating them in rate by a lot. We're seeing interest rate differences where we are at 0.75 or just shy of 1% or so, up to 1.5% lower in rate. And the main reason is I'm gonna go ahead and pop up a little chart here. And in that chart, it's a graph. It's a chart. It's going to be a spreadsheet that shows interest rates and payouts. And this is what a lot of lenders don't want you to know. There's margins that are built into the industry. And most of our competitors have a lot of margin built into the rates. And how it works is simple. Back in the day, 15, 20 years ago, they used to kind of paraphrase it and say you had the front end and the back end, right? The front end, you'd pay points and origination. The back end was the margins built into the rate. Well, that's still around today. So you'll have lenders that can charge origination at 1 point on the front end, and they can charge a discount 1 point on the front end, depending on how they work their pricing. Origination points and discount points are exactly the same. The other way of doing it is inside of the interest rate, and that's where the majority of mortgage companies put their money. And a lot of times they'll split it, and there's complicated rules which we could go into. Give me a call and we can go into those complicated rules. But in the end, origination points, discount points, and the margin that's built into the rate itself dictates what your rate is or what the cost of that rate is. So for us, when we compete against somebody else, it really is a competition of the cost of the rate. And that's a competition of efficiencies. So the more efficient your mortgage company is, the lower cost per acquisition or the lower cost per loan that closes, guess what? You don't have to charge that much in markup, which means your rates are lower. But every single mortgage company will have a markup built into the rate. It's not us, it's not just like Wells Fargo and Chase and some of the other banks and whatnot. Everybody does. But here's the big kicker, right? We hold our borrowers accountable to a few rules that the other lenders don't. So for example, we have an online portal. You need to have a computer and be able to use the online portal, right? When we request documents, we need those documents back right away. And for a buyer, if you're not getting us documents, we're going to pull your agent in pretty quickly. And if that's not doing it, then we need to respect the seller and go grab them and say, hey, we're still waiting on some documents. And that allows us to be fast and efficient because there's two main bottlenecks on doing a loan, the appraisal and borrower documents. So how are we cheaper than everyone else? If I were to summarize it, it would be our cost of operations are significantly lower. We don't have a bunch of middle management and people in the middle that are just soaking up costs of each loan. We also don't allow the costs of one loan to affect another loan, which most mortgage companies do that. So for an example, if they pull credit on 5 people and each one of those credit pulls, let's just say it's $100 to keep the math simple, that's $500. None of those loans close and you have a 6th that goes in and closes, well, that $500 goes into this person's mortgage cost. That's how most mortgage companies operate because they're operating on base P&L. We don't do that. We're okay with losing money on some loans, believe it or not, but most mortgage companies are not. Some are, most are not. So there's a few ways that we're more efficient. Really fast operations. I mean, we're getting loans underwritten in a few days. We've got very, very low overhead because of efficiencies and whatnot. Borrowers are very efficient. Our systems are extremely efficient. And then we've got this other big key thing. Our loan volume is very, very good. Mortgage companies want our loan volume. Why? Because the borrowers make their payments, the interest rates are low, so they don't refinance right away, and that's called first payment default and paying on time and EPO early payoff. We don't have either one of those two problems. We just don't have that. Why? Because our rates are already lower than everyone else, so there's no reason to go refinance out of it unless you're pulling money out or something like that. But with that being said, lenders want our loans. They want your loans. And so they're willing to offer us rates a lot of times that are lower than other competitors. So for example, we have a sweetheart deal with one of our, I want to say one of our Govy lenders, and they really like the loan volume, and they offered a handful of us really, really low margins. So they're doing the same thing. They've streamlined their operations. They cut their costs down. Their rates are lower, and then they're offering those rates to us and a handful of others of our competitors. But out of all of our competitors, we all talk and we all know what each other's doing, at least on an ownership level. And people don't understand why we mark up our loans so little, like why our markup is so small. They just say, dude, you can make a lot more money. It's like, I know, but I'm doing volume. And they don't want to do volume. They want to make a lot of money on a few loans. I want to make a little bit of money and do a lot of loans. So I guess that leads into what we did last year. So I won an award for loan volume with the Scotsman's Guide. In the middle of the summer, you're going to see another award pop out, which is I'm a veteran. And they keep track of veterans and how many loans they did. So I'll end up being on that award as well, midsummer. But in the end, though, too, it's a difference of philosophy. We want to be really, really fast and really, really cheap and do a lot of volume. Other lenders, and I talked to a loan officer the other week, and they said, no, I don't want to do, this is what the other guy said. He said, I'm a veteran. I help other veterans out, but man, I have to make my money on the deal. I have to make my, it was a lot. It was over 2% of the loan amount as his commission. And I'm just like, really? Seriously? So in essence, I'm doing a lot more loans than he is. It's kind of funny. It's kind of cute. Okay, so let's go into rates themselves. Government for us, we're still in the fives. Hold on one second here. Hey, let me call you right back. I'm doing the video. All right, yep. All right, so government, we're middle, so we're high fives, and some money will get you closer to the middle fives. But again, that's no origination, no discount. And then conventional, you're going to be mid-ish sixes with just a little bit of money. It'll be on that email that's sent out. But yeah, that's where the ballpark range of what you're looking at, where you're at. And with that being said, it's amazing the difference. Oh, rates this week. Okay, so rates this week. Sorry, I keep thinking about how we're just doing so much cheaper than most everybody. It's incredible. Okay, so rates this week. Last week they went down a little bit. This week they went up. Why? It was data. Monday it went up. I'm going to show you a chart real quick here. Excuse me. Monday it went up because of anticipation of data, but also data itself was showing that the Fed's probably not going to do decreases in their Fed rate right away. And of course, a few Fed speeches says, yeah, it's probably going to be 2. It's going to be a little later this year, but data's not quite there yet. We're going to wait for more data. That's what the Fed said. Now, the Fed, I'm going to simplify things. The Fed dictates the overnight banking rate from one bank to another, or the Fed to loan money to another bank overnight, because there's rules that banks have to zero their books out every night. So a lot of times they borrow from each other, but if not, they can borrow from the Fed. Great, right? That's really all that affects, the Fed rate. Now there's a trickle down to that. And with mortgage-backed securities, it's never directly linked to what the Fed is doing. In fact, the money for mortgage-backed securities is mortgage-backed securities, the stock market, and the 10-year Treasury. And that's kind of where that money flows. It's more complicated than that, but that's kind of a simplistic view of it. That's why a lot of us look at the 10-year Treasury. And if we see the 10-year Treasury going up, which is the chart I'm going to pop up, it goes down last week, it comes back up this week. But if you notice, over the last few months or so, it's kind of hit this high point where it kind of settles out and then goes back down. It's kind of dribbling up and down. But that's a 10-year Treasury, and if you look at mortgage rates, they tend to follow that. They're not exact, it's not one-to-one, but they tend to follow that basic trend of going up and down. And that's kind of nice because you have kind of an indicator of where rates might be going, right? So anyways, my name is Mike Florin. I hope this helped you out. But yeah, if you want to use us as a mortgage lender, it's pretty simple. Own a computer, be fast with your documents, and basically do business. Not do business in that regard, but do business as in, I need a bank statement, get us a bank statement. Just get it done, right? So if you can do those things and you take care of your credit, not great credit, but you take care of it, great. Everything will work out great. Come on over. We'll chat with you. Everything's good. If you're somebody that just doesn't ever give documents and just, if you don't give documents up and you're just trying to push your limits, we're not the mortgage company for you. We're pretty pretty conservative in that regard. But anyways, my name is Mike Florin. I'll talk to you later. Have a great day, and I'll see you later.